Hello everyone, hope you are all doing good. So today we are going to discuss another small cap stock, Manali Petrochemicals Ltd. So this is our session number 91. In the earlier sessions, session number 89, 90, all these sessions we had discussed about stocks like Nava Limited, another small cap company, which has grown more than 80 to 90% from the levels which we have told. Now, the other company which we had discussed in detail was Rajesh Exports. I had told the red flags in that company, and if the problems related to that company, if it is sorted, then we can get a breakout in that stock. But currently, the concerns are still there, and I still have not received the response from the company officials regarding the queries I raised to them. So we still await a green flag for the company. I will be updating about you about that company once I get a clarity from the management. Now, if you see my session number 54, which is the stocks I had bought in year 2022, Independence Day special, it was. So this was streamed almost a year back. At that time, I had told that I had entered into the small cap company, Manali Petrochemicals. The price which I had entered was at a higher level, definitely at that time. But I have got a response from various subscribers and other investors uh, mentioning the concerns about the subdued performance of Manali Petrochemicals as far as the stock price is concerned. So today we will be discussing in detail about the company. As always, it is going to be a little long video wherein we will be discussing about the fundamentals of the company, the complete valuation of the company, what is the company all about, what are the products of the company, what is the management, who are the competitors in the market for the company, what are the risks related to the company, what is the capex analysis, what is the future plans of the company, the industry outlook, then the various financial ratios, the working capital management, the operational efficiency, and also I have included the intrinsic valuation of the company, wherein we will be finding out the intrinsic value of the stock and compare that with the market price and understand whether it is undervalued, overvalued, or fairly priced. And finally, towards the end of the video, I give a conclusion wherein what is my outlook on this company and what is that I'm going to do about the stock. So, disclaimer: I'm not a SEBI registered financial advisor. So, whatever I'm going to share here is my viewpoint and my analysis about the company. You can perform your own due diligence, contact your financial advisor, and take sensible decisions on investing in the particular stock. So without wasting much time, let's directly get into the analysis. So the company name is Manali Petrochemicals Limited. I am recording this video on 27th September 2023. So all the figures which I have mentioned here, including the stock price, is of that particular date. Now talking about the company or the business model, Manali Petrochemicals Limited is incorporated in 1986 as a part of AM International Group. So basically, Manali Petrochemicals is a Chennai-based manufacturer of petrochemical products, namely propylene oxide (PO), propylene glycol, which we are abbreviating as PG, polyols, system polyols, and other allied products. So the company has two manufacturing plants. It is named as Plant 1 and Plant 2, both located in Manali, which is in Chennai. Plant 1 was set up in 1990, whereas Plant 2 was initially started as UB Petrochemical Limited in 1990 by the UB Group, which was subsequently acquired by Southern Petrochemicals Industries Corporation (SPIC) in 1995, as SPIC Organics Limited was merged with MPL, which is Manali Petrochemical Limited, in the year 2000. So MPL's products are import substitutes and cater to a wide variety of end user industries. Import substitute in the sense there is an option that the products, whatever we mentioned here, so propylene oxide, propylene glycol, PG, polyols, etc., can be actually imported from outside a foreign country because there is no manufacturer of the same in India. There is no major manufacturer of the same in India. So basically, whatever MPL is manufacturing is a substitute to the probable import which would have done from the foreign country. So MPL is the only domestic player in the segment in which it operates and faces competition only from imports. So again, the companies engage in the manufacturing and sale of, as we told, propylene oxide, propylene glycol, and polyols. So these polyols are used as industrial raw material. It manufactures polyol in 4 grades such as flexible slab stock, flexible cold cure, rigids, and elastomers. This is like, I'm just trying to make you understand about the product. So it is very important that before investing into a company, you should not barely invest into the company. You should know about what products the company is manufacturing and how sensible it is from the consumption point of view and the business model point of view. The company products are used as application in various industries such as appliances, automotive, furniture, footwear, paints, coatings, pharmaceuticals, food, and fragrances. So it is a wide variety of industries which is covered as far as the products of Manali Petrochemical is concerned. The company also develop products to suit the customer or community requirements. Its other product include propylene glycol monomethyl ether (PGMME), which is used in paints and coatings and electronic industries. So what you should know from all these things is that though there is a concentrated manufacturing of all these chemicals by the company, the products or the application of these products is into a wide stream of diversified industrial applications. So though it is concentrated in the particular chemical production, the application being diversified in the industry, there is no concentration risk. Now, knowing about the product. So the main product is, as we mentioned, propylene oxide. So MTPA is million tons per annum. So around 18,000 million tons per annum of propylene oxide is manufactured currently by Manali Petrochemicals by its plant 1 and plant 2, as we mentioned earlier. Propylene glycol is 12,000 million tons per annum. Polyol is 22,700, and other products include dichloropropane, which is 3,600, dipropylene glycol 1,500, and tripropylene glycol, which is around 200 million tons per annum. So these are the main products which are being manufactured by the company. So you should know about this product as well. Now talking about the power source of the Manali Petrochemical plant. In the sense, for manufacturing these chemical products, which are mainly crude oil based or derivatives from crude oil, for them the plant requires both power, which is electricity, and steam. So these are catered by basically 2 boilers, one boiler each in plant 1 and plant 2. So originally these boilers are furnace oil fired FO fired boilers which generate steam, and this steam is being utilized for running the steam turbine for generating power and also for generating the electricity which is being used for the chemical plant's power needs. And also a part of steam from the boiler is utilized for the various process steam requirements inside the chemical plant. So for plant 1, if you see, the oil fired boilers are already being converted into LNG, liquefied natural gas fired boiler, and the LNG is supplied by IOCL. And plant 2 actually awaits the gas connection from IOCL, and once the gas connection is obtained, then they will be converting this oil fired boilers also into gas fired boilers. The conversion is mainly because of the cost economics and the operational point of view. The gas being comparatively overall, the cost of operation and the economics is fitting in compared to the oil fired system. Also, the plant has got one biomass fired boiler, mainly wood chip fired, which is powering the captive power plant. This was commissioned in 2008 and actually was shut down in December 2014 as the wood chip prices and the wood prices continue to be high with no assurance on consistent supply due to consumption of the biomass in the paper industries. Also, furnace oil and LNG remained a cheaper option compared to the increased wood prices, or as far as the increased price of biomass is concerned. So they have shut down the plant and they have concentrated on utilizing the boiler for powering the CPP through gas firing. And earlier it was oil fired, and one of the plant is still using, plant 2 is using oil only. Plant 2 is using furnace oil only for the moment, but soon it will be converted to gas fired. And few of the equipment in the biomass plant which is shut down is also utilized in plant 2 boiler, so that they have saved the some of the fixed costs for the boiler. Now talking about the owners or management. These are the promoters. So promoter holds around 44.86% of the total company, out of which 53.15% is public holding, which includes people like retail investors like us. Then 1.96% is held by foreign institutional investors, not much of holding as of now. And 0.03% is by DII, the domestic institutional investors. Like mutual funds hardly have holding in this company. The major holding is mainly by the promoter and rest by the public. So talking about the 44.86% promoter holding, out of which 38.35% is held by SID Life Sciences Private Limited, and the rest 6.52% is held by TIDCO, the Tamil Nadu Industrial Development Corporation Limited. So SID, the South Indian Drugs and Devices Private Limited, was set up in 1988 and is engaged in providing medical devices for tertiary care such as blood oxygenators and cardiotomy reservoirs, life support segments, as well as airway management, neurology and transfusion, and was later renamed as SIDD. So that is all about SID, the major stakeholder, and the other one is the TIDCO, so which holds 6.52%. Now talking about the founder of the company, Mr. Ashwin C. Mutaya, who is the chairman. So he is holding the so he is associated with the company since decades, and uh, he's the founder chairman of AM Group of Companies, Singapore, which is the holding company of all these subsidiaries. AM Group of Companies have interest across globe in fertilizers, petrochemicals, distribution, infrastructure, health, and green energy. So if you want to further read about Ashwin C. Mutaya, you can go through this. But he is a person with great integrity and great experience in the product which he's dealing with. So as far as my study is concerned, he has deep knowledge about the product, and how to drive the business forward is clearly known to him. Now about the product. Company operates in polyurethane PU industry. In chemical terms, PU is a polymer containing carbamate or urethane linkage found by reaction of isocyanates with polyol. So basically polyurethane is found by reaction of isocyanate with polyol, polyol being the main product of Manali Petrochemicals. So polyurethane has got a wide variety or wide range of application in the industry, which we'll be discussing here. So the main product of Manali being polyol is actually participating in the PU industry. So it is a mixture of compound containing urethane, urea, isocyanates, allophanates, etc. PU, a combination of both soft and hard parts such as the said urethane and urea, is a versatile plastic polymer available in various forms, right from rigid foam, flexible foam to strong and hard elastomers. So foam, I need not mention, you know about foams, the one which is used in sofas, beds, etc. And PU can be customized in various combinations and structures for application in a wide range of products for improving energy efficiency and improved physical and chemical properties. This helps PU to be used in wide range of consumers and industrial applications such as thermal insulation in buildings, refrigerators, household furniture, shoes, packaging, plastics, etc. So you can see there is a wide variety of end use applications for this product. So though Manali is manufacturing 5 to 6 chemical products, the usage of that, as I mentioned earlier, in the consumer industry is very large, and the product has got wide range of applications. So that shows the relevance of the products manufactured by Manali. Again talking, PU offers unique properties like good abrasion and wear resistance, elongation, resilience, flexibility, scratch resistance, mechanical strength, adhesion, low temperature, thermal insulation, electrical insulation, etc. Owing to this, PU can be molded to any shape to enhance its industrial application by providing comfort, style, and convenience to one's needs. Due to wide range of properties and forms, it finds application in rigid and flexible foam, fiber, film, composites, elastomers, coatings, adhesives, and mainly caters to industries like automotive, appliances, building and construction, energy, defense, paints, and coatings. soft furnitures, etc. So that is the wide range of industries it is catering to. PU is becoming popular in construction and infrastructure activities owing to its characteristics like durability, low thermal conductivity, ability to withstand external impacts, etc. Increasing expectations of high performance, lightweight interior components, and cushion forms in automotive parts to achieve energy saving also contribute for further polyurethane market growth. So that is all about polyurethane and its main role played by Manali Petrochemical in supplying polyurethane to the market. Now talking about the group companies or the subsidiaries. So companies subsidiaries include 100% subsidiary, which is Alchem Specialty Chemicals Private Limited, Singapore. So that is the 100% subsidiary. And another one is recently added Manali Specialty Private Limited. So this is mainly incorporated after acquiring the company Pen Globe. So regarding Pen Globe, we will further decode in the coming slides. Now the step down subsidiaries include earlier Alchem Specialties Chemical UK Limited was there, but recently it was as a part of restructuring done by the company. The net assets of this subsidiary is transferred to Alchem Specialty Chemicals Limited, Singapore, the 100% subsidiary, and this company is completely liquidated. So this Alchem Specialty Chemicals UK Limited is no more there. So mainly the step down subsidiaries include Node Dam Limited. So they are into manufacturing of Newton polyurethane cast elastomers catering to customers primarily in automotive and agricultural sectors. So MPL has started using the know-how from Notre Dame and introducing these products in the domestic market. So this was again as a part of acquisition by the company. So this company has got strategic acquisition of various uh, other companies, especially in foreign countries, for getting the know-how, for getting the technology, and then uh, manufacturing it in a cheaper way using its plant in Manali, Chennai. So the technology comes from outside and the manufacturing happens here. So it's a unique combination of strategic business technique by which the company manufactures the product with the technical know-how from outside India and makes the product feasible, saleable, and to get higher profits for the unique products which they are manufacturing. Now again they have acquired a company Pen Globe Limited UK, which is having uh, the associated companies like Pen White Limited and Pen White Print Solutions Limited. So this is the latest acquiring by the company. So uh, Pen White Limited UK is acquired in November 2022. So if you see, Pen Globe Limited UK was recently acquired by the company in November 2022 last year, and Pen Globe Limited again has the uh, technology know-how for the similar products manufactured by Manali. So that is why they have strategically acquired this company. The details about the acquiring of this company and for how much cost and all it is acquired will be discussed in detail in the coming slides. So this Pen Globe Limited has got two subsidiaries, which is Pen White Limited and Pen White Print Solutions Limited, both located in UK. So all these three has become the step down subsidiaries for the main group. So it has got mainly four step down subsidiaries: Notre Dame Limited, Pen Globe Limited, Pen White Limited, Pen White Print Solutions Limited UK. Now talking about the industry outlook. Globally, the petrochemical industry is a cyclical business. So cyclical industry is characterized by volatility in both feedstock prices and demand. So feedstock in the sense the main product here is crude oil and the derivatives of crude oil is being utilized by the company for manufacture of all the products as mentioned above. So as you know, the crude oil prices keeps fluctuating. So it has gone to 135 last year. Now this time it is currently, as I speak, it is around 90 dollar a barrel. So there is a huge fluctuation in the price, and this will actually impact the uh, product margin and the product pricing, because once the crude oil price increases, then the input raw material cost for the company increases. So if they are unable to carry forward the increase in the cost to the end product, then they will have to absorb the difference, and this will lead to reduced profit margins. And if they are conveying the increased price of the crude oil to the product, then the product will become costlier, and then the consumers may import it from outside from larger players wherein they are able to give it at a lower price. Then this will impact the company business or revenue. So demand for petrochemicals generate from the downstream industries which are dependent on the state and growth of economy, and in turn would influence the demand for MPL's products. So suddenly, outbreak of COVID-19 has rendered an unparalleled slump in manufacturing activities across several parts of the globe. So this has led to lesser imports from outside, and hence the in-house manufacturing of MPL, the products is been bought by the players, and then the revenue has increased, and also because of the uh, COVID issues, there was lesser manufacturing outside, so imports also reduced. So this helped increase their profit margin as well. So disruptions in the trade flows and logistic constraints due to lockdown measures taken across also negatively impacted the industry. However, with easing of lockdown, all relative downstream sectors have begun showing a rebound. So that is why if you see in 2021, 2022, the companies having the largest revenue and largest profit margin. If you see the last past 10 years. So food grade PG market with surge in demand from pharmaceutical application is expected to support propylene glycol industries to recover from impact. Auto and consumers durable demand has also picked up, and companies prospects would continue to largely depend on global demand supply dynamics of its major products. So further, MPL's ability to optimally utilize its manufacturing capabilities and manage competition in the form of imports and comply with changing environmental norms. So like emission, then the green energy needs, carbon footprint, etc. Anyhow, the company is concentrating on that. This would be the key to its prospects going forward. So mainly, okay, mainly the manda. So now let's talk about the risk analysis. Unlike in 2021 and 22, sales volumes and values of the company dropped significantly from the third quarter as more imports dumped into the market at cheaper price. As I told, large big players has been dumping uh, and increasing the uh, exports and hence the import to the country, and this has led to cheaper prices. So cheaper pricing means the MPL will have margin pressures, and margin pressure will lead to reducing the product cost and hence impacting the profitability. So if you see, unlike the COVID times 2021-22, wherein the imports has reduced and hence improve the margin of the company. In 2023, the volumes has also dipped, and so is the profit margin. With the Russia-Ukraine conflict and other global markets fearing recession, prices were continuously dropping, and company sales volume were also affected. During the fourth quarter of financial year 2022-23, even though the demand was slightly better than the previous two quarters, but still the prices were at pre-pandemic levels. So this has actually led to lesser profit margin. Though overall sales volume was relatively similar to that of the previous year, product prices have reduced drastically to pre-pandemic levels, which eroded company's margin, as I told, during the financial year under review. Due to company's relatively moderate scale of operation in a cyclical industry dominated by imports from global integrated players who enjoy benefits of scale and diverse product portfolio with limited control on pricing of finished goods and volatility of raw material prices, which is the crude oil, restrict the profit margin of the company. So that is like, first of all, the crude oil is cyclical industry, so the prices keeps fluctuating, which will affect the company's profitability. And also there is no larger scale of manufacturing by the company, though company is now taking up the capex and expanding the PG production capacity of the company. So once that capacity expansion is done, then again the company will have larger scale of production, and maybe it can get price advantage as well. So they can increase the volume, and though profit margins are lesser, they can have these benefits of scale. Also, company derives around 85% of the revenue from PG and polyols. While the product concentration is high, as we discussed earlier, This is mitigated to an extent as the end segment that the company serves with these two products is diverse. Like we spoke about, lot of applications, end use applications for the products. Though the product portfolio concentration, though the product portfolio is concentrated, the end use is very much wide and serving to various industries. So there is no concentration risk. Another risk is that there is continuous R&D cost. So, for example, they have recently set up a pilot plant for CO2 substitution for polyol manufacturing, which is a green energy solution, wherein they are trying to substitute CO2 for polyol manufacturing. So, this is like a green energy solution. So, going forward, this will help them, especially for carbon footprints, etc. But again, this will require huge R&D cost. So, the product has to innovate, keep innovating. So, they have to spend much on the R&D cost. So this R&D cost can actually impact the profit margin of the company. Now, another thing is that high competition from the global integrated player and cheaper imports, which we already discussed. So the major global players include Dow Chemicals Group and German major BASF. So they have large capacities which enable them to offer higher quantity of polyols to Indian market at lower prices. So this will actually increase the imports to India, which will impact the sales of the Manali Petrochemicals, because they will not be as such able to match the lower price of the big players. So even if they are able to match it, then they will actually erode the profit margin, which has recently happened. So again, we spoke about the import substitutes. So this is actually affecting the company sales and profit margins, and also prices of the finished products manufactured by MPL generally move in tandem with the raw material prices, with some time lag, as they are derivatives of crude oil, and MPL prices its finished products based on the respective landed cost of imports, which limits control over the end product pricing. So the product pricing is directly dependent on the crude oil price, we can say. In polyols, this has moderated to an extent due to the levy of anti-dumping duty (ADD) on imports from Singapore, Saudi, and UAE from time to time. So if anti-dumping duty is being incorporated, then this will actually help boost the profit margin of the company. Another thing is the margin exposed to raw material price volatility, however mitigated by end-to-end price revision, which we already discussed that it is dependent on the the price of the raw materials like propylene and PO has remained volatile in the past depending on crude price. However, prices of the finished products manufactured by MPL also generally move in tandem with the raw material prices, although with some time lag. So as the industry is characterized by price volatility, the EBITDA margin of the company also remain volatile. The company has a competitive edge on the freight cost front, as the plans of the suppliers of major raw material, which is propylene, PO, and chlorine, are in close vicinity to MPL plant. That is like the MPL is getting the raw materials from basically the Chennai Petrochemical Corporation Limited refinery. So from there only they are getting the crude oil derivatives, which is propylene. So propylene, which is the major raw material, is sourced from Chennai Petroleum Corporation Limited only, which is CPCL, which is another listed company in the stock market. So as both these plants are very close, it is very easier for them to easily ship the or transport the propylene from plant to plant. Now talking about the industry risk and prospects. So already we discussed it's a cyclical industry, so volatility of feedstock prices and demand, it is dependent on that. So demand of the petrochemicals generated from the downstream industry is dependent on the state and growth of economy, and in turn could influence the derived demand for MPL products. While there is a huge gap in domestic demand and production, the competition from large integrated global players act as an entry barrier to any new entrants, as the incumbents can aggressively price due to their integrated facilities, which domestic standalone player cannot match. With the domestic demand being higher than the domestic capacity, the offtake risk for domestic producers is low, driven by end users need to maintain an alternate to imports. So MPL is actually serving as a alternate to imports. However, their performance remains susceptible to changes in government policies and regulation regarding international trade and trade protection metrics. Currently, to promote the domestic players, additional dumping duty has been imposed by the government on the imported polyols. So this is actually helping to improve the profit margin and revenue of the company. Also, financial year 21 and 22 marked a unique year. As I mentioned, the pandemic, before the pandemic there is a slump, and subsequently there is lockdown everywhere, there is issue of transportation. So the imports were so much subdued at that time. The MPL could raise its production to the highest level, almost more than 95% planned productivity, and they had a largest ever volumes of products being manufactured, and also the profit margins were also higher. So that is a one-time case. Now we cannot expect that in the coming years. So going forward, the PG and polyols market are expected to have a steady growth driven by growth in pharma applications and auto segments respectively. So pharma and auto segments are the two sectors which we have to watch as far as the profitability related to MPL is concerned. The ability of the company to sustain its current market share, scale up the operations as anticipated while maintaining the margins would remain key to the prospects of the company, because this is what we should look at for boosting the revenue and profitability of the company going forward. Another risk is that the plant which the company is having a leasehold land. So period of this lease related to the leasehold expired actually in June 30th, 2017, for which the request for renewal for the further period of 30 years has been filed by the company with the government of Tamil Nadu, which is under process. So they are telling that the management is confident that the renewal of the lease will be granted as requested, as the land has been put to use for specific purpose for which it has been allotted, and hence no adjustments for impact of non-renewal, which however is uncertainable at this point of time. But the companies or the management is confident on this, that they will get the extension on the lease. So they keep on doing the lease agreements every 30 years is what is I could understand from this. So again, if you read this, it is mentioned that for this demand of 19,000 or around 20,000 lakh as arrears for the lease rent up to 2016 related to plant to leasehold, for which no details were provided by the authorities. So though company has received similar claim in 2013 and 2014, that is again without any details. So the company had told uh, that this claim is baseless and they will not be able to pay it. So there was arbitration involved also. So again, and in the financial statement of the company, they have made provisions for this lease, uh, the payments as rent against this lease. So that is what they have mentioned in this session. But however, the clearance of the lease agreement is awaited currently by the company, and since 2017, and hopefully the things will get cleared, is what company is mentioning. Now getting into the capex analysis, the company is expanding the PG capacity at the polyglycol capacity at an estimated cost of around 150 crore to be done in two phases. So this will strengthen the presence of MPL in domestic market, as substantial part of the PG demand is met through imports. So once the production capacity is increased, the MPL starts producing in large, so they can compete with the bigger players like BASF and Dow, and then they can also play on volumes, and though with lower margins, they will be able to utilize the economics of scale. The first phase of expansion is to involve an outflow of around 65 crore. So over the past 4 years, the capacity utilization of PG plant was more than 95%, and in 2021 it was almost 100% during the COVID times. And the capacity enhancement and the company will then be able to meet a major portion of domestic demand and compete against the imports. The company also has plans of putting up a polyester uh, polyol plant with a total estimated cost of around 40 crore, which also to be done in two phases. So this is done in two phases so that capital intensity is reduced. The capital expenditure along with other routine capital expenditure are likely to be funded out of internal generation. So probably the company is not going to take any debt, and whatever profits the company is generating from the business, that only will be as of now considered to be utilized for funding the capex requirement for this capacity expansion. So the project of capacity augmentation of PG, which is propylene glycol, is in progress. Out of the proposed additional capacity of 50,000 TPA, so they are proposing a additional capacity of 50,000 TPA. So if you see the original capacity of the plant, as we mentioned here, is propylene glycol is only 12,000. So additional 50,000 is like huge addition. So currently it is 12,000, and they are adding 50,000 TPA. So in that tons per annum, TPA is tons per annum. So in the first phase, 32,000 TPA would be added, and within 18 to 21 months from the start date, the plant will be commissioned. So necessary regulatory clearances were obtained from the MOEF and CC and the State Pollution Control Board. So in the last annual report, company had mentioned that the project has been delayed due to longer than usual time for processing by the environmental clearances. So company has got necessary regulatory clearance from the MOEF. So MOEF is Ministry of Environment, Forest and Climate Change. So these are like environmental government organization for clearing the EC, which is the environmental clearance for setting up the plant. So they have got the clearance. Now detail engineering activities have been completed close to 70%, and floating of offer for civil jobs is under initiation. So the engineering stage for the plant is slowly going on. So as they are not taking up the capex in a full single financial year kind, they are gradually executing the project without much cash burn. So realistically, it would take another 22 to 32 months as per me for capex realization, basically for utilizing the complete capex and setting up the uh, first phase of 32,000 TPA of propylene glycol manufacturing plant, and the project is completed without impacting the free cash flow. So free cash flow, as we already know, operating cash flow minus the capital expenditure. So lower is the capital expenditure, and as the company keeps generating profit, so the free cash flow is not much affected, uh, and the company profitability also is maintained. Along with that, the production capacity increases means the company revenue increases, again enhancing the company performance. So this is all about the project, the expansion of propylene glycol plant for 50,000 million tons per annum. And the plant also, in addition to propylene glycol, they are also going to manufacture dipropylene glycol and tripropylene glycol of respective capacities as mentioned on the screen. Now, if you see the screen here, I have just plotted the cash and cash equivalents plus the investments of the company, which is in green. So in 2016, it was around 75 crore, reduced to 39 crore, then increased to 68 crore, 61, 60 crore. Then it has increased to 286 crore in 2021 and 2022. If you see, the company performance has been always better as far as everything, including the revenues in 2021, 2022, while there was lockdown and there was import impact, and the company has produced a lot and uh, encashed the demand in the domestic market and gained a lot on profit. So again, in 2023, the cash and cash equivalents has reduced to 384 crore. So the cash and cash equivalents in the company books is now currently at 385 crores around. And also debt has been reduced. So if you see, the debt earlier was in 2019 33 crore, then 25 crore, then in 2021 it was reduced to 14 crore, in 2022 it was reduced to around 18.67 crore, and as we stand in 2023 it is just 6.6 crore, which I can call it as just debt free. Capex requirement also, if you see, in 2017 was the highest, 123 crore. Then as you see here, in 2022 it is around 27 crore, and 2023 it is around 44 crore only. So again, it has been utilized for expansion of the polyglycol plant, and also the capex here mentioned doesn't include the uh, acquiring of the subsidiary Pen Globe Limited UK. So that details will be mentioned in the coming slides. So talking about the moat, the unique competitive advantage which the company is having as far as its business is concerned. Warren Buffett always believes in the moat of the company. So as always, visionary and experienced management, people like Mr. Mutaya is there to lead the company with strategic acquiring and business strategies, which will increase the profitability of the company going forward. The long-standing operational track record of the company with a product portfolio that caters to a diverse end-use segment. So, diverse end-use segment we already saw in the earlier slides. Huge or the diverse variety of market industries it is catering to. So the products are like 5 to 6 numbers only. So they have a long-standing operational track record. Uh, and also company is the only domestic, basically in India, manufacturer of propylene glycol PG, which we mentioned. So only competition is the imports. So if they are able to enhance the capacity and have economics of scale, then they can easily beat the imports and become a larger or bigger market player. Also, it is the first and largest Indian manufacturer of propylene oxide, the input material for the PG derivative products, and global presence and player. So they have got various subsidiaries outside India, including in Singapore, UK, etc., which they can utilize, and they have a global presence. So this can be utilized for enhancing their business. MPL is the only domestic player in the segment in which it operates and faces competition only from the imports and no Indian competition. So that's the one of the unique competitive mode wherein if they uh, concentrate on various good acquisitions, technology transfers, and backward integration, and improving their plant efficiencies, then they can definitely uh, cater to the growing needs of the industry and improve the profitability as well. So application of the products by MPL. So MPL, as I mentioned earlier, caters to players in pharma, food flavoring, bedding, mattress, and automobiles, limiting risk of concentration in one industry. In polyol segment, almost 20% of the demand is from automotive industry, and other major demand is from foam and bedding. So it is also used for insulation panels and waterproofing in the construction segment, which we already discussed. PG is used. So PG, propylene glycol, is used in drug formation, in drug formulations in the pharma industry, as food preservatives and solvents in the food industry, and as carriers in flavor and fragrances, etc. So US FDA has also approved this in application in pharma industry. So this is a huge positive thing for MPL as a producer of PG. Now, if you get into the institutional data, the foreign institutional investors actually has been selling the stake in the company. So in 2022, it was around 3%. Now, as the company revenue drop and also the profitability reduced, it seems that FIA has exited the company. So almost 1% has been reduced by the FIA in the company holding. And if you see DII, the domestic institutional investors, it has never excited them. So mutual funds and all didn't have much holding. So in June 2022, around 0.05%, and currently it is 0.03%. So almost the holding has been the same, and mutual funds are not much holding the company as of now. Now, acquisitions is what the company is known for. So, Manali Petrochemicals by UK firm Pen Globe, like we discussed earlier, in 2000 crore deal. So, the deal is actually not 2000 crore, it is slightly more than that. We'll discuss that in detail. So, this is Mutaya, and uh, this is the representative from the Pen Globe group, Pen Globe Limited UK. So the company board has approved an additional investment up to $35 million in AM Chem for potential overseas acquisition. The acquisition of Penglobe Limited is in connection with this. So Penglobe was acquired for uh, 21 million GBP. So there is still amount available for the allocated by Amchem Group Singapore for acquiring more assets or more businesses. So we can going forward expect more acquisitions by the company. So see in November 2022, the acquisition was done at around 24.98 GBP. So the British pound it is. And as we already discussed, Penwhite Print Solutions is subsidiary of Pen Globe Limited. So the Penwhite Print Solutions will be liquidated during the financial year 2023-2024, and then as it is mentioning here, 31st March 2023, there are no assets or liabilities, and this will be incorporated as a wholly owned subsidiary in India, is the Manali Specialty Private Limited. So on 23rd June 2023, so which will be engaged in the business of specialty chemicals. So they have absorbed the technology from the Penwhite Print Solutions, and this will be the company in India, which is newly formed Manali Specialty Private Limited, will be actually utilizing the technology to manufacture various products, and using the technology know-how from Penglobe. And here also they are mentioning about Norddome Limited UK, incorporated a wholly owned subsidiary in Germany with Norddome Europe GmbH, which will be engaged in the business of chemicals including polyurethane casting, elastomer systems, and related products and services. So these are all strategic acquisitions by the company. Notdome Limited was 2 years back acquired by the company, and all these acquisitions shows that the company is having proper business plans and acquisitions in place to improve the business. So again, this is the updates on subsidiaries. So already we spoke about Pen Globe Limited. Now already regarding Alchem Specialty Chemicals Limited UK, we already told that it is completely restructured. As a part of restructuring, net assets has been transferred to Alchem Specialty Chemicals Private Limited Singapore. So UK unit is been completely liquidated. Now again talking about Manali Specialty Private Limited, again revising what I have told earlier. So the earlier subsidiary of Manali Petrochemicals Limited, incorporated in 23rd June 2023 in Tamil Nadu. This is again based on the technology transfer from the Pen White Print Solutions, which has been completely liquidated and merged to the Manali Specialty Private Limited, incorporated in June 2023. So Pen Globe is leading player in foam control agents and related chemical products including lubricants, surface coating, release agents, and silicone emulsions. The board of two companies approved the acquisition process. That is the statement from MPL said. So the addition of Pen Globe is an important step in the execution of our growth strategy, which is what the Manali Petrochemical Management is telling, and it gives us access to world-class products, technology, and talented teams as a strategic advantage. So this is mentioned by Ashwin Mutaya, Chairman MPL, and also Founder Chairman AM International, as I said earlier. The acquisition will help MPL augment its capabilities in catering to its global customer base and looking forward to implement new technologies in India and Asia specific markets besides Europe, the release added. This will enable us to expand and strengthen our footprints in Asia and grow our portfolio to cater to a globally diversified customer base. John Whitehead, Managing Director of Pen Globe, said. So latest acquisition in line with MPL's approach since 2016, it acquired another UK-based company, Notdome, which I mentioned, which manufactures Newton polyurethane cast elastomers. It finds application in automotive sectors, among others. That acquisition enabled MPL's leadership team to focus on Europe and develop it as a location of choice for its future expansion and growth investments, the statement said. And also Penwhite is uh, Penwhite Limited, which is the subsidiary of Pen Globe, is a specialty chemical company and manufacturer of foam control agents and similar chemical products including lubricants, surface coatings, release agents, and silicone emulsions. And another subsidiary of Pen Globe, which is Pen White Print Solutions, is a printing service company and a manufacturer of wide range of performance silicone emulsions, anti-statics, and consumables developed specifically for the needs of commercial printers. So this is all what is about the acquisition of Pen Globe Limited. Now you can see the Pen Globe has become the 100% subsidiary of the company. So again, Pen White Limited, the Pen White Print Solutions, Notdome, and also this I already told. Number one, it's already there, and number two is completely liquidated and merged with Singapore Amchem Specialty Chemicals Private Limited. Now, if you see in 2023, the cash and cash equivalents has been reduced by around 233 crores. So where this 233 crore has gone? So very clearly, if you see the cash flow statement, so under the cash paid to acquire subsidiary, so around 241.79 crore. So this is 233 crore, and another some few crores has been added. So 241.79 crore has been spent for what? For acquiring the Pen Globe Limited. So in the news also you heard here that the company has been bought for 24.98, which is equivalent to 241.79 crore, which is reflecting here in this, see, in this cash flow statement. So that is where it has been spent, and that is why the cash equivalence has been reduced by 233 crore. Now another news was that Manali Petrochemicals to acquire minor stake in First Energy for power procurement. So First Energy is actually a sister company of the Max, which is a Pune-based company. Already you know. So First Energy Private Limited has got an agreement with Manali Petrochemical. So Manali Petrochemical to acquire minor stake for procurement of solar and wind power under a captive generation scheme. The transaction valued just around 3.56 crore, which will enable Manali to secure a stable power supply for its operation. So already we mentioned that they are having issues with the oil-fired, gas-fired boilers, so biomass-fired boilers. So they are looking at green energy solutions, which is offered by First Energy Private Limited. So this will help. Manali believes that this will help have a sustainable green energy solution, which will help sort their energy needs. So that is why they have got a initial investment of around 3.08% and subsequently hold 2.59% of paid up equity of FEPL upon the commissioning of the plant. So consideration of this part of agreement amounts to around 2.48 crore. So that is a small initiative by the company for green energy solutions. Now talking about the figures. Now almost the theory part or the fundamental part of the company we have already discussed. Now let us get into the finance or the figures of the company. Now if you talk about the shareholders fund, it has been improving over the years. So 2016, 17, 18, 19, 20, 21, 22. So 22, 23 it has been almost flat, but still there has been a consistent improvement in the book value of the company or the shareholders funds. So steady growth, though little saturation in 2023. Now if you see goodwill, Ben Graham or even Warren Buffett always tells that while considering the book value of the company, you should remove the intangible assets. Only the tangible assets, physical form assets should be considered. So goodwill is something which is not to be considered as per me. So if you see in 2022, the goodwill has been just 9,000 or 94 crore, but which has been increased to 281 crore in 2023 March 31st. It is basically after the acquisition of Pen Globe. So addition during this year, if you see as per the note, there is 185 crore addition in March 2023. So if you see Manali Petrochemical has acquired, so he has mentioned in the note 51, refer note 51, he has mentioned, so in that group has acquired 100% equity of Pen Globe Limited for a consideration of 246 crore, and Pen Globe Limited and its acquisition Pen White Limited and Pen White Print Solutions has become 100% subsidiary. The consideration for this business acquisition includes contingent consideration of GBP 1.5 million payable sellers by the group upon achieving the certain financial condition as per agreement executed by sellers on group 30th November 2022. So actually that 185 crore goodwill has been added due to Pen Globe acquisition. So this is kind of artificially inflated the book value. So again have a relook at the shareholders fund. So if you take out that goodwill, then the actual book value drops to 859. The shareholders fund becomes 859 crore instead of 1044 crore. So there has been actually a dip in the book value. So obviously the amount has gone out as the payout for acquisition of around 240 to 45 crore. So that is directly reflecting in the book value. So if the newly added 185.62 crore goodwill is not considered, then the shareholders fund drops to 859 crore from 1044, which I mentioned. And also book value, if you see, there has been a steady growth and there is a saturation in 2023. And again, if you consider that intangible assets of goodwill taken out, then the actual book value becomes 50. So again, there has been a drop in the book value in 2023. So with this reduced book value, the price to book value becomes 1.3 from currently projected 1.07. So obviously the book value is less, means price to book value will be higher. But still 1.3 is a fairly priced or fairly valued stock, not overcooked. And now coming to PAT, the profit after tax. So the performance was largely on the back of supply side issues, that is the reduction in import to India, impacting the availability of imports, leading to increase in prices of its products. While this situation is gradually returning to previous levels and the flow of imports have increased, the company's profitability is also expected to normalize. So which you can see it, the normal profitability is like this, the PAT is this. Here there has been a increase in PAT due to the COVID situation and the reduction in import. Now the profit has again fallen back to 50.67. So it seems it has normalized again. So this was only a one-time situation, it seems. The major growth is seen in 2021, 2022 only. So net profit margin also, if you see the same thing. So due to supply related issues, realization in PG has witnessed a growth of 103% over uh, FY21, while volume growth was at 10%. Realization of slab stock polyols and systems polyol witnessed an increase of 4 and 24% respectively. From the end of Q4 FY22, supply chain challenges have subsided and imports have gradually increased, thereby leading to ease of prices. So ease of prices means the profit margin erodes for the company, and hence the profitability is highly impacted. If you can see here, the impact of this is reflected in Q1 FY23. So if you see the net profit margin also is reduced, very much reduced in this, you can see. So margin dropped below 5% actually. So at least 8% margin is desired. So it has fallen beyond that. If you see in earlier times, 2019, 2016 and all, 8 to 9% was maintained. And 2023 it has dropped below 5%. Also, if you see the operating revenue versus the PAT. So just to have an idea, this is the brown thing is the actually the sales or the operating revenue, and the green portion is the profit. So bigger the green in comparison to brown, it is showing that the profitability is more, and hence the PAT is also more out of the total sales volume. But if you see, there is a thin margin only. Like I told, the profit margin has dropped below 5% in 2023. So even though the revenue is 1,200 crore, the PAT is just 50.67 crore. So improvement in operational performance in FI driven by supply chain disruptions. The company has consistently utilized more than 95% of its PO and PG capacity. In case of polyol, the utilization has improved over the years and maintained at 50 to 60 level, which was improved to around 75% in FY22 due to some debottlenecking activities. While the revenues and PBILD remains volatile as product prices are linked to crude and there is considerable pricing pressure from imports, which we all discussed, MPL has consistently delivered stable operational performance over the years. FY21 and FY22 mark exceptional years for the company's operational performance with a sharp increase in top line and margins, with margin touching 36% in FY22 as against 9% in FY20. This is all what we mentioned earlier. So which is mentioned here for your even more clear understanding. So capex, there was a capex peak in 2017. After that, the capex has been almost stable and in a not much higher trend. So the company is not spending much on the capex, uh, though it is acquiring some subsidiaries. So that cost is different. Now free cash flow, it has not been stable. If you see from 2016 to 2019, many times it has been negative, and 2020 onwards it has been a gradual improvement, and 2021 and 22 obviously the sales revenues has been high and profitability has been high, so the free cash flow has increased. Now again in 2023 it has fallen back to 47. Going forward, hopefully they have a stable capex plan and higher profitability or stable profitability, which will ensure a positive free cash flow. This is the free cash flow per share. So per share, it has been 11.29, 20.11. Now it has fallen to 2.75 in 2023, following its free cash flow total amount. Now cash and cash equivalents versus the free cash flow. So green is cash and cash equivalents. So it has reduced to 384 in 2023. Free cash flow also we already discussed. It has fallen to 47.34 crore in 2023. Total debt, there has been a consistent debt reduction. It has reached 6.6, which is almost debt free. The company is almost debt free, considering its equity. Debt equity is very low. Working capital requirement is something which shows its operational efficiency. So in 2023 and even starting from 2020, there has been an increase in working capital requirement. But in 2023, it has been slightly reduced. So I expect the any company to be more profitable, it should reduce its working capital requirement. You should get the payments from the customer upfront compared to the payments to be done to the vendors, or supplies from which the raw material is procured, so that it has got a lower working capital requirement or even a negative working capital requirement, so that the company is good in its operational efficiency. Net current asset value per share, again a metric by Ben Graham. So here if you see, the net current asset value per share has been increasing in from 2020 to 2022, but it has slightly reduced in 2023. It is currently at around 38 rupees per share, wherein the stock is trading at around 65 rupees. So the stock is definitely not cheap, but not overpriced as well. So as per Ben Graham, the two-third of net working capital should be the stock price, or below that, if the stock is trading, then it is considered to be undervalued. So stock is currently trading at around 65 rupees, as I told, a premium of around 73% over its current liquidation value. So net current asset value is nothing but the liquidation value of the company as per Ben Graham. So the stock is trading almost 73% above that value. So definitely not undervalued for sure. Now there is a graph which I have plotted for cash and cash equivalents, total debt, free cash flow, net current asset value, working capital, capex, and PAT. Just to give you the, you can just have a pause on the screen and you can analyze the curves and how the cash and cash equivalents has been improving, then it has been reducing. Though the debt has been paid off and reduced, the free cash flow has been dropping in 2023. Net current asset value also I told, it has been increasing, but slightly dipped in 2023. Capex requirement also has been gradual, not that capital intensive, and PAT has been dropping since 2022. So this is all, everything is being captured into a particular graph so that you can have a more analytical point of view. So net current asset value is similar to working capital, but instead of subtracting current liabilities from current asset, total liabilities and preferred stock are subtracted. So which you already know about net current asset value. Now talking about the current ratio. So current ratio is nothing but the current assets divided by the current liabilities. So current assets mainly include cash and cash equivalents, account receivables, plus inventory, plus the marketable securities like bonds, mutual funds, or other easily liquidating securities. And also current liabilities include notes payable, accounts payable, accrued expenses, unearned revenue, current portion of the long-term debt, plus the other short-term debt. So mainly account payable is what we account there. So if you see, the current ratio has been increasing over the period. So in 2023, it is at 4.58. So if you see increase in current asset, generally speaking, it is good, but as per me, it is not that good, because if you see, if the receivables increase and also if the inventories increase, it shows the lack of operational efficiency. So receivables increase means you are not getting the payment from the customer upfront, so it is increasing the receivables, and also inventory is getting built up, means you have manufactured the product but it is not getting sold. So if this two increases, then also the current asset increases. So numerator value increases means the current ratio increases. So if the accounts payable is decreasing, means you are upfront paying the cost to the raw materials to your vendors. So it shows your lesser muscle power. So accounts payable upfront you are paying, and so it is reducing, means the denominator is reducing. So in both the cases, the current ratio will increase. So if the current ratio is increasing because of the cash and cash increase in cash and cash equivalents or the marketable securities or the increase in cash component, then it is good. But here what is happening is because the receivables and the inventory is increasing, building up, and the accounts payable is reducing, because of which the current ratio is improving. It is not actually a good uh, thing for a highly efficient operating business. So this current ratio has to either improve by improving the cash and cash equivalents, otherwise it has to come down by reducing the receivables and inventory, and accounts payable has to go up so that the working capital requirement also comes down. Now talking about the CCC, cash conversion cycle. So if you see, as I mentioned earlier also, the lower the cash conversion cycle, the better the prospects of the company, or the better the efficiency of the company is. So In 2021 to 22, the cash conversion cycle has reduced a lot. The inventory has come down because there has been a huge sale, and also the payment by the customer has been upfront, though the payments to the vendors has been delayed. So this is the best case of having a good cash conversion cycle at that time. And also, if you see, uh, though in that period the working capital requirement has increased, the cash conversion cycle has reduced, which is a good thing for improved business efficiency. But again, if you see in 2023, the cash conversion cycle has increased back to the earlier levels, which is not that good from the efficient business uh, perspective. Now, in 2000 March 2017, if you see, there has been a uh, capital expenditure of around 195 crore, which is mentioned in the balance sheet, uh, basically in the cash flow statement. And if you see in this is for 2017 period, what is this? The capital expenditure on fixed assets, including capital advances. And if you see here, the same capital expenditure on fixed assets, including capital advances, in March 2017 is mentioned as 123 crore. So 195 crore has become 123 crore. So why this difference? I have seen this difference in the cash flow statement of the company. I probably may write to the company to understand why this difference, but maybe some accounting mistake or something. But this is a huge gap of around 70 crore, so I don't know. So but as I was analyzing that, I came across this accounting mistake, so that is why I mentioned that. So here it is only 123 crore, and earlier it is 195 crore for the same period. That was some observation. If you see debt equity ratio, as I told, the company is almost debt free. See, the debt equity ratio has improved over the period. In 2023, as we stand, the company is almost debt free, which is very good. The ROE has improved as high as, see, if you see 30 to 36, 37% in 2021, 2022. And again, it has fallen back to a subdued level of around 5% only in 2023. So ROE has to be improved going forward. ROCE also similar, and it has fallen below 10% or below 7%, 7 to 8% in 2023. It also requires improvement. As I already told, there has been margin pressure because of the crude oil price, higher crude oil price, the input cost, and the inflation requirement, inflation fears and all. So if that is improved, I believe that the company profitability is bound to increase. And also, I have shown a comparison of US Brent crude oil price comparison to its uh, over a period of time. So I have plotted this from 2016 to 2023. So 2021-22 it has increased above $100 and again in 2023 it has dipped to around 85-90 per barrel. So though in 2021-22 the price has increased, the sales volume was also high, wherein the company could make bigger profits. But in 2023, though the comparatively the crude oil prices has reduced, but still it is at a higher price, impacting the profitability of the company. Now, company's net profit margin along with the crude oil price is been plotted here. So this crude oil price is in dollar per barrel, you should know, and net profit margin is in percentage. So net profit margin has been reduced to very 4.28%. Reasons is already mentioned in my earlier slides. So there has been a reduction in the Brent crude oil price, but still it is higher compared to the earlier time. So hence it has affected the profitability of the company. Again, the ROC, ROE, and net profit margin is plotted along with the Brent crude oil price. So higher Brent crude oil price has led to lower profitability margins and the return ratios. Price to earnings ratio, if you see 2023, obviously overcooked lacks earning power. Earnings needs to be improved a lot. So as the profit increases, the earnings increases, PE ratio will drop. The PE ratio will drop at least below 10%. It will give a comfort as far as the valuations is concerned. Also, price to book value, it is almost at 1. So that from book value point of view, it is okay. But again, we discussed that there is intangible assets because of the goodwill. So if you remove that, then the price to book value is increasing from 1.07 to around 1.3, which is still okay as far as the valuation is concerned, but still you should realistically understand that the price to book value for Manali is around 1.3. EV to EBITDA is around 6 and a half So which is also attractive as far as the valuation is concerned. Asset turnover ratio. This metric helps investors understand how effectively companies are using its assets to generate sales. So the ratio is around 0.95 as we currently stand in 2023. So higher the sales means with the same assets you are generating more sales. So sales has obviously dropped in 2023. Now talking about the inventory turnover ratio. Inventory turnover is the rate that inventory stock is sold or used and replaced. A higher ratio tends to point to strong sales and a lower one to weaker sales. So if you see the figure has dropped to in 2023, so sales has obviously been reduced because of the reasons stated above. So this also needs to be improved going forward. Depreciation expenses is something which I always look at. So to know if there is any accounting red flags, we have already mentioned about various accounting red flags in my earlier session. So if you have not seen that, you can go see that. So here, if you see the depreciation expense has been gradually increasing over the period of time, probably because there has been acquisitions of various companies, and probably because of there are some plans associated with various companies, and depreciation of that may be added into this value. And though this figure is not that big, 23 crore, so still the intent is that you should always draw such a curve or understand how much depreciation the company is applying on the equipments and whether it is in line, or if it is drastically changing, it shows that the company is manipulating the profits of the profit figure. But here it looks fine. Now intrinsic value of the stock. So Warren Buffett told price is what you pay and value is what you get. So let us see what is the intrinsic value of this company. So let us directly go into our intrinsic value calculation sheet. So I have mentioned about this company in my earlier session 55, Manali Petrochemical. So I have mentioned the PE 5 years average PE year intrinsic value is coming to be around 17.29. So we need not see that because based on that, because earnings has been thoroughly beaten down. So if you see that, based on that, the margin of safety is negative because the market share currently is 65 rupees, and we are getting an intrinsic value as per price earnings multiple as just 17 rupees. So let us skip that. Now, as far as the discounted cash flow model is concerned, we'll put all the figures here. Based on that, what I'm getting an intrinsic value of 61 rupees. So 61 rupees means that the margin of safety is not there because currently the stock is trading at 65 rupees. So it is trading at its intrinsic value. So the margin of safety is not there, but still the stock price is not overvalued. It is kind of rightly priced as far as the cash flow is concerned. But now, as you know, there has been capital intensive requirements in the past, and also profitability has been impacted. Once you improve the profitability, the free cash flow will increase. Once the free cash flow increases, then the DCF model will project a bigger figure of intrinsic value, which will give some margin of safety. Now, as far as the ROE valuation model is concerned for intrinsic value, then there we are getting a intrinsic value of around 168 rupees. So that is actually giving a comfortable margin of safety of around 160%. So only one model is giving it a comfort, rest all it is not giving. So as obviously the free cash flow has reduced over a period, so this has impacted the DCF model. So DCF model is what I normally follow for price projection or the intrinsic value calculation. So it is not actually giving a good signal here, but we'll have to believe the company's future prospects and see if the wait for the free cash flow to improve, and if that is done, then we can get a improved intrinsic value from the DCF model as well. Now getting back to our final stage of the presentation, conclusion. So why I am going to hold, or uh, maybe think if I should buy, probably I will not be buying because I have enough stake in the company. So I will be holding this company because of these following reasons. One is visionary and experience management. So I am pretty optimistic on the company's future prospect as far as the strategic movements or the strategic business plans the company is going to incorporate going forward. The long-standing operational track record of the company with the product portfolio that caters to a diverse end use segment, which we already mentioned, large portfolio of segments which is catering to. Strategic acquisitions and backward integration. So investment in subsidiaries, MPL has been consistently looking out for acquisition targets which would help the company in product differentiation through unique formulation and IP rights. For this purpose, the company had set up a wholly owned subsidiary, Amchem Specialty Chemicals Private Limited, Singapore. So this was set up in September 2015 to identify potential investment opportunities across the globe and hold all the foreign assets of Manali Petrochemical Limited. So as far as the strategic acquisitions and backward integration is concerned, companies really focused on that. So this can create value for the investors for sure. Going forward, the capacity expansion is already in place. The company is in process of expanding its propylene glycol plant, which is already operating at around 95 to 99% capacity for the past 3 years. The same is expected to further increase the market share of the company in the domestic market, since most of the domestic customers have a policy of not wholly depending on the imports for its RM supply. Being the sole domestic producer is the favorable for MPL. So the domestic companies will not actually completely depend on imports. They will also identify a domestic player. So in this case, it is MPL. So that is also a unique moat or the soft point for the company as far as its consistent sales is concerned. Now, debt reduction, the company has been cutting the debt over the period. So reducing the debt means the financial cost, the interest rate expense also is reduced, thus improving the profitability. And also, company is funding the capacity requirements as per the plans by internally generating the profit, and the profit is being utilized for funding the capacity requirements, including that for the capacity expansion of the PG plant. And also CPP efficiency improvement is something they are looking at. They have switched from furnace oil to LNG fired unit, and they are now exploring green energy solutions. And also they have stopped the inefficient biomass fired boilers. So they are conscious on the efficiency improvement of the captive power plant perspective. So if they going forward incorporate a higher efficiency boiler as well, which can happen also. So this will also improve their production efficiency and hence boost their profitability. And reduction in capex and improving profit margin, hence improving free cash flow, is what I'm uh, looking at. So reduction in capex and cash burn has to be reduced, and improving the profit margin by various strategic acquisitions. I'm sure that they will be able to create value and improve the profit margin, and hence improving the profit margin can lead to improving the free cash flow as well. Now, stabilization in crude oil price with increasing dependency on renewable energy sources is something which is a thing a theme which has to play going forward. So, in such a case, the crude oil price can come down. So, this can reduce the raw material cost of the company, and then this can also improve the profitability of the company, and also the capacity expansion can build in the economics of scale, wherein the company can sell more and with a lower profit margin though, but then they can have a higher chunk of revenue, and also and hence higher sales volume means higher profitability, uh, not from the higher margin perspective but from the larger volume perspective. So these are some few uh, factors which I am considering for actually holding on to the investment rather than selling. Now I know the stock has fallen from its all-time high to as low as 50 rupees or 45 rupees, but now it is currently trading at 65 rupees. I don't discuss about chart or technicals, but as far as what I know thoroughly is the fundamental analysis which I have done here, and also the intrinsic value calculation I have shared with you. So as per me, going forward, the company under its efficient or strategic management plans can have a turnaround story and improve the profit margins and have a positive free cash flow. And please note that this is not a stock recommendation. I emphasis on this point again. I'm not a SEBI registered financial advisor. So you do your own due diligence, contact your financial advisor, and whatever I have told you, go through that, analyze that. If you have any doubts or clarification, please feel free to comment in the below comment box. If you like this content, you please share this with your friends and relatives, so that they also come to know about the company and how to analyze a company. My efforts has been to help you understand a company, how the business works, how to analyze a company, and independently allowing you to analyze various companies. So hope this session I hope this session was useful for you. I'll come up with further analyzing videos going forward. See you in next video. Till then, happy investing.